We're excited to kick off with our first Fireside Chat, which will be hosted by Gillian Tett, Editor-at-Large and Chairman of the Editorial Board at the Financial Times. She leads the FT's editorial operations in the region across all platforms. She writes weekly columns for the Financial Times covering a range of economic, financial, political, and social issues throughout the globe. She's also the co-founder of Moral Money for the Financial Times, which is also a great read. I'd like to invite Gillian to the stage to introduce our first Fireside Chat.
Good morning, everyone, and welcome. It's great to be here on behalf of the Financial Times, and I'd like to welcome you all to this event. It is a beautiful day, beautifully sunny, but as you all know, there are some major storm clouds gathering over the global economy at the moment. One of these, obviously, is populism. You heard some remarkable comments from Ray Dalio yesterday about his fear that rising levels of inequality is going to be leading us all to end up fighting each other. That's sparking some very volatile, uncertain populist politics. It's sparking growing geopolitical tensions, trade tensions, never mind whether or not we do actually have a deal between President Xi and Donald Trump. And then we have the wider concerns about the economy and the fact that central banks are pretty much out of bullets with their negative rates across the world. And of course, the fiscal stimulus that we probably need to see has not yet materialized. And yet, as Donald Trump tweeted out a few minutes ago, stock markets are at an all-time high. He has advised you all to, one, feel grateful for him having delivered that personally, and two, to spend your money wisely, is what he says. So what on earth is happening? Well, I can't imagine a better person to explain all this to us than Mohamed El-Erian, who is a long-time financial luminary, who has provided many great columns for the Financial Times and also sits on the FT's Business Book of the Year judging panel, but also himself wrote what I think is one of the most prescient books of recent years called The Only Game in Town, about whether central bankers really are out of bullets, and if so, what that means going forward. So Mohamed, I'd like to invite you up to the stage. You are now going to give us all the answers. So, are you concerned about the global economy?
Short term, no. Long term, yes. I think it's hard to deny that over the last few weeks, things have gotten less worrisome.
Less worrisome.
Less worrisome.
I think that's code for better.
Better is a strong term.
You're sounding a bit British. Masterful understatement. Okay, so less worrisome. Why are we less worried?
Labor market remains strong and is outperforming expectations, which means the U.S. consumer remains strong, which means the most important part of the U.S. economy remains strong. Secondly, there is less trade there's an easing of trade tensions. Like you, I don't think it's permanent, but there is a short-term easing of trade tensions. Third, there are signs of bottoming out in the European slowdown that, again, today were confirmed out of Germany. And fourth, the market has embraced, too optimistically, but has embraced a policy handoff from excessive reliance on central banks to a more comprehensive policy response. So you put all these things together, and to me, it is no surprise, given how this market has been conditioned over the last few years, that we are at all-time highs on the US stock market, and that the bond market and the FX market and volatility are extremely well behaved. But ask me to look forward beyond the next 3 to 6 months, and then it gets really, really cloudy.
Right. Well, let's pick those points one by one. Let's start with trade. Okay, so we have this new intense speculative game in town in Washington right now about where exactly Trump and Xi are going to have their next love-in. Is it going to be in a cornfield in Iowa or a soybean field? Are they going to go back to Mar-a-Lago? Where is it going to be? Do you actually believe, though, that the trade war between the US and China is actually over or even ameliorating?
No. I believe we're going to get a truce, a ceasefire If you want to be really optimistic, we're going to get a mini deal. But is it a stepping stone to a permanent peace? No. We're going to stay in a no war, no peace for a while. And most likely, we're going to tip back into tensions. And you have to understand why. First, none of the genuine concerns are being addressed. They are intellectual property theft, stopping it and being able to verify that you've stopped it. 2, forced transferred, all sorts of implicit forced transfers of technology that goes on. And 3, an unfair competitive environment for not just US companies, but European companies setting up in China. These things are not being addressed in any sustainable manner. 2 is that for the US especially, but also for China, this is no longer just about economics. This is about national security. And the minute you bring in national security, it's much harder to solve. The phrase I hear often in Washington, and Gillian, I'll be interested if you do as well, and it comes from both parties, is the following. If not now, when? If we don't stand up to China now, when will we stand up to China? It will be too late. So there is this national security underpinning that makes it most likely that the mini deal will not stick beyond its political use-by date. And that's how I think one has to think about this. So no, these trade tensions haven't gone away. They've just been de-escalated for the short term.
So memo to markets, it's not just about soybeans. Although actually politically it is about soybeans right now. But,
it's not just about economics, I think is the even stronger statement. It's well beyond economics right now.
I mean, the thing that strikes me, and I know you spend quite a bit of time in Washington, you know, in the White House and the Fed, as do I. And on my recent trip to Washington, talking to people in the White House, what struck me was that even as they are busy saying potential trade deal, or some of them are saying potential trade truce, they are also making it extremely clear to American companies that they want them to get out of China and that the supply chain rupture is not just posturing, it's deadly serious, that they are actually trying to rupture the supply chains. How bad do you think that's going to get? And what does that do to business investment? Because you're seeing, you know, a pretty sharp decline in capex in the US right now. The recent GDP figures were really quite chilling in that respect.
So first, I think business itself is realizing the importance of diversifying supply chains. Okay, so this is not just coming from the White House. I think that business itself realizes they should do that. And I can give you example after example of companies I know that have faced short-term disruptions in China as a tit for tat for what was happening at the global level. The other thing that I find fascinating is forget about the US, forget about China, go to Singapore, go to Australia, and ask the question, how do you feel? And they are really concerned because the strategy so far has been, whether you're a US company or whether you are Singapore, and especially if you are Australia, because Australia is part of the Five Eyes intelligence cooperation, is you have two options, the cost of which are very cheap. One option is on US for national security. Singapore, Australia, a US company operating abroad, you have an option to be protected by US, and it's a pretty cheap option. And the other option is on the Chinese market, selling there, sourcing there. And so far, most people have been willing to run, able to run, have these two options at very low cost. What's happening right now is that it's no longer clear they are things that you can do simultaneously, and it's becoming more costly to maintain that option. And what they're terrified of is to be asked, choose. Which one do you want? Because it's not clear how you make that choice. And if you don't believe me that that is a possibility, look what happened in Germany after the US withdrew from the Iran deal. The US ambassador brought together, and this is completely public, he talked about it on television, he brought together the CEOs of the German companies and said the following: I'm not going to tell you how to run your businesses. That's completely up to you. I'm just going to tell you the consequences of how you run your businesses. And if you invest more in Iran, you'll do less business with the US.
Yeah, well, I think you make a great point there. I've just backed myself from Asia, and if you look at, say, what's happening around Taiwan with the chip sales right now, that's a classic example where essentially companies are being asked to choose, and that's going to get more and more intense. And of course, in Japan, they're absolutely horrified by having to make this choice. I mean, perhaps Japan crystallizes that choice more clearly than anywhere else.
And technology is at the forefront. I mean, that's where the first battles are happening.
To what degree do you think this is going to lead to a serious decline in business investment? And could this be the spark for the next global recession?
That is certainly, people know my view. I talked about it in the 2016 book. I said within the next 5 years, we're going to hit this T-junction where the road we're on is going to be ending. And the road we're on is one that has been supported massively by central banks. And then we face two very different alternatives. I wish I had held back the book for 2 years.
Well, you can always reissue it with a new intro.
That's what the publisher wants to do.
Well, hey, listen, we can collectively all have a communal effort to create a new intro for you.
Right. So I do think that one of the potential outcomes is exactly what you said. It is recession, it is global financial instability, and it is really messy politics. I give that a 60% probability in the T-junction. The 40% probability is that the political system will respond, because this is not an engineering problem. And that's what, if you want to be optimistic, that's what you should hold on to. This is a political implementation issue. So the engineering of getting to sustainable, inclusive growth, getting to genuine financial stability, which means not liquidity-based financial stability, but fundamentals, and politics that start restoring the middle, the center. The answer is, we know what we need to do, we just haven't had the political courage. And I think that when you put it that way, you raise the questions. Ray Dalio was talked about the social and political implications of a period of low and insufficiently inclusive growth. We can talk about, I honestly don't know whether we have just pressed the pause button on globalization and we're going to just press play again, or whether we are going to press rewind. And if we have pressed rewind, the system is not wired for deglobalization.
I mean, one of my favorite charts from Ray Dalio is a chart he did about populism a few years ago that I imagine almost everyone in the room has seen. And if you haven't, go online, Google Ray Dalio, LinkedIn, and populism, and you'll find what, to my mind, is the most astonishing chart I've seen in recent years that shows that the proportion of the Western vote voting for populist candidates went from around 5% in 2010 to about 40% at the end of 2016. Sadly, they haven't updated it yet. Maybe they can do that in tandem with your book. And the only time in history we've seen that kind of swing occur was between 1930 and World War II, when we again had a swing from about 10% to 40%, which of course ended up in a reset called war. Are we heading for a global war?
I don't think we're heading for global war, but I think we're heading for global instability if we're not careful. I think of this as a hollowing out of the middle of the distribution, the political distribution. So you've hollowed out the center, and you have the two tails going up. And the two tails are very strange because you get populism on both sides. In fact, you get combined populism. The Polish government that has just been re-elected is an extreme right implementing extreme left policies, right? So what you see is what we have grown up with, which is a bell-shaped distribution. And bell-shaped distributions are very comforting because they're stable. The center holds, the tails are thin, are being turned into bimodal ones. That's on the political side. But guess what? It's on the social side. The middle class is being hollowed out. Therefore, you get this social anxiety going on. You get the politics of anger. Guess what? It's on the economic side. Guess what? It's on the institutional side. Guess what? It's on the market side. Whatever distribution you look at, the center, the middle, the belly is going down, and the tails are going up. And we all know that a bimodal distribution is a more unstable distribution. So that's why I think that this is a generalized phenomenon of the hollowing out of centers of distributions, and it's going to lead to greater instability. Now again, I say, you don't need to say this is the end of the world, because it's not a 100% probability. It's over 50 in my view. And the answer to that is you embrace this uncertainty. You embrace these bimodal distributions and understand that you have to do things differently.
Wow. So welcome to the bimodal world. That's not a very comforting thought. I must say, having come back to the UK, that's a classic example where the centre is completely hollowing out right now politically, and it makes US politics look positively rational right now, what's happening in London.
And let me ask you, so what happens in London is something else also, is when people get angry, they become single issue voters. When they become single issue voters, they are very eager to dismantle without being clear of what they want to build instead, right? So what's going to happen in Brexit, it's going to be really important as to whether you can bring this back to something that actually solves.
Right now in Britain, you've got Italian-style politics without the good food, sadly. But on a serious note, what do you think central banks could or should do now? I mean, are they, you wrote this book called The Only Game in Town. It was very prescient, almost too prescient. Are they still the only game in town? And can they actually do anything, central banks?
So they are the only game in town. And I just came back from Germany last night. And I met lots of private sector German people like you, the equivalent in Germany. And they all laughed when I said there are great expectations for a major fiscal stimulus. They laughed. They laughed because A, part of them don't think you need it. What are you talking about? The non-tradable sector is doing great. Unemployment is at all-time low. Construction is booming. We can't find workers. What do you mean stimulus? The second group says it won't work. Our problem is trade. Our problem is autos. How do you expect stimulus to work? A third group says it's too early. We need to be shaken up. We are fundamentally able to navigate this on the private sector. And then a fourth group says, you know what, even if we need it, our politics simply don't allow it. So put these four things together. Their view is at most you're going to get a mini fiscal stimulus. And that's in huge contrast to what the rest of the world expects. So this handoff from excessive reliance on central banks is not happening anytime soon. We can hope it's going to happen. It's not happening anytime soon. Meanwhile, central banks are less able and less willing to continue what they're doing. On the less willing side, look at the divisions within central banks. Look at what's happening within the ECB. And that relates to less able. And less able because there is a view now, and I buy it 100%, that in the case of the ECB, for example, not only is continued use of unconventional policies ineffective in delivering economic outcomes, it's counterproductive. It is counterproductive because negative rates and Q infinity break things in a market-based economy. Okay? And I think that realization is starting to grow, and the Fed doesn't want to end up there. So yes, central banks are going to be the only game in town still for a while, but they're going to be less able and less willing to play that role.
So there is no game in town?
There is a weak game in town, yeah.
That's even less reassuring than a bimodal world. What about the idea that maybe what the ECB could or should be doing is looking at entirely novel approaches like green QE? I mean, we're fascinated by this because, as you've heard earlier, one of the things I did recently was to co-found a website called Moral Money. It's part of the FT, which is looking at the explosion in all things ESG related and looking not just at green finance, but the wider questions of corporate governance. And if you haven't seen it, do click onto the FT and look at it or get the newsletter. And the fact that Christine Lagarde has arrived at the ECB and one of the first things she's waded into in terms of the controversy about green quantitative easing, the fact that this has cropped up is not just an extraordinary sign of the times, but you could say it's also an attempt to rethink policy quite significantly. What are your views about green QE? Is that what is going to force Germany to change course?
So I think green investment is going to result in more public investment in this area, and it's needed. And green QE is a combination of the insights of modern monetary theory and the importance of taking climate change seriously. So it has good foundation. And could I see central banks establishing a facility here on the side to do this? Yes. Is it going to be a QE? No. Because when you grow up in central banking, there's certain rules that you abide to. One, which has served markets extremely well, is that central banks are not in the business of creating crises, we're in the business of buying time. Like a doctor, they'll continue to prescribe painkillers, even though they cannot solve the underlying problem. And that has helped markets enormously because we've had ample and predictable liquidity. But the other thing that's just as deeply embedded is you do not mix monetary policy with other stuff that try to fix market failures, because you'll end up in the muddled middle. So you try to separate that. So do I see a small facility for this? Yes. Is it going to be a green QE? I don't think so.
Right. What about modern monetary theory? Because this is an idea which was completely outlandish 3, 4, 5 years ago. I mean, really in the territory of crackpot economics. And yet it's slowly creeping towards the mainstream, like many of the other ideas which, have been embraced in the last decade. And even Ray Dalio has pointed out that, you're seeing this policy slide towards MMT, and it's beginning to be seen as more acceptable. Are you expecting that we're going to end up with some version of MMT as a result of all this?
We're going to end up with the insights of MMT. And I learned from...
The insights.
The insights of. So I learned from Mike Spence, who is a Nobel Prize winner that some of you may know, one of the smartest people I know, that when someone says something ridiculous to you, and it sounds really ridiculous, listen to them, because they may have some insights. QE sounded ridiculous at the time.
Bank nationalization sounded ridiculous once.
Yeah, I mean, there's so many things that sounded ridiculous. But what is the insight of MMT? It's a very simple insight. Central banks have been doing quasi-fiscal operations. Interest rates are negative or ultra low. Therefore, the way we think about debt, if you have a central bank willing to use balance sheet and interest rates are very low, the way we think about debt and its relationship to financial sustainability and viability should be evolved. That is a really important insight. Now, do I take it as far as central banks should become complete agents of governments and simply decide, for governments what they're going to do, or worse, simply fund governments without any hesitation? No, I don't take it that far. But I do think we're going to think differently about the stock of debt, the servicing of debt, and what financial viability means. And the market is already there. The notion that Greece could issue at negative yields, okay, the market had far run ahead of this issue. I think way too far. I think it's ridiculous to buy negative yielding Greek bond, but people did it.
Well, maybe you can buy negative yielding Greek island instead. At least you get some upside to it. But what do you think about the US, though? I mean, do you think the implications of that are that the US debt is just going to keep rising, that Donald Trump or his successor will end up with more stimulus? And could US interest rates go negative?
Yes and no. I think we are going to have more debt. And you know what? Some of it may not be bad. There is massive infrastructure needs in this country, both to modernize what we have, but important to build what we need. And if you can fund it at for 10 years at 1.83%, the social return on that investment in most states of the world will be higher. So if we have an investment-driven stimulus funded by debt, I actually think it's a good thing. Why? Because debt sustainability is a ratio. We all focus excessively on the numerator, stock of debt, debt service, but the denominator, the income you generate, is as important. So if you can have growth-enhancing debt financing, I'm all for it. No, we're not going to go to negative rates because even the ECB realizes that that's a bad idea now. When the ECB launches a public analysis of negative rates, that's telling you something. And I think that there is growing evidence that we're nearing a tipping point where negative rates are going to be really problematic.
In what way?
In 4 ways. First, they encourage savings. So they are reverse stimulus. Because people, especially in bank-based systems, who have in their mind a certain standard of living and have large cash balances, Germany being the example, when you pay them less, they save more. Japan was an example of that. So you encourage the wrong sort of behavior. Secondly, they make the supply of long-term financial protection products very hard to do. If you came up to me today and said, I'm starting a life insurance business, I would short you your business everywhere I can. Okay? That is a financial protection product. It goes to household security. It goes to how risk-averse households are. So that's an issue. Third, they encourage excessive risk-taking by non-banks because you push people to do silly things, buying negative yielding bonds issued by Greece. And finally, you encourage really bad resource allocation economy-wide, including the zombie companies that have been a real issue in Japan. There's enough evidence on all of these 4 things for you to be worried. Now, it's a non-linear process. Everything goes on for a while, and then suddenly it starts being cumulative the way around. And I think that within the ECB, there's growing awareness that they're getting closer to that tipping point.
So that begs really 2 questions. One is that, the White House has indicated, Donald Trump, that he would like to see, if not negative rates, that rates moving in the same direction in the US towards Europe and Japan. The White House does it, I think, primarily because they're increasingly seeing monetary policy as an offshoot or an outpost of currency wars and trade wars, and for them it's increasingly about currency wars as much as anything else. Are you concerned that the next logical step of where we're going will be currency wars or capital wars, and that we could see a lot of currency volatility as a result, competitive devaluations?
So where have we come from? We've come from a trade war, and I think we've pressed a pause button. I don't think we've fixed anything. That's been talked about a lot, but there's been something else going on. There's been an investment war going on, by the way, if you haven't noticed. The regulation that have been governing cross-border investments have gotten harder.
Yeah.
Okay. Add to that we've weaponized sanctions. So we've had a very visible, explicit trade war. We've had a less visible investment war. And if these 2 things explode again, then we're going to have a currency war. Yeah. I think that's why these tails are unusually fat. Is because if you get into a recession, you're going to trigger a currency war. Right? So that's why it's what economists call multiple equilibria. You don't revert back to the middle. Whether you go this way or this way, your next most likely step is further down whichever tail you've gone in. There's no longer a center that brings you back to the middle.
Right. And this really is my last question. I know we're sadly almost out of time. We could carry on all day, I think, but getting you all even more depressed. But
no, I hate when people say it. I think on the contrary, if you embrace it before the rest of the world, that we're living in a bimodal world, there's a ton of money to be made.
Right.
Okay?
This is what these guys in the room are, girls are about.
No, but you know this. You've studied people. I mean, I don't know how many people know what her background is. Tell them what your background is.
You're wondering what I'm doing up on the panel.
No, on the contrary. Okay.
I've been a journalist with the Financial Times now for 2 decades, just over 2 decades. But I was actually a cultural anthropologist. Before I became a journalist, I did a PhD in cultural anthropology, studying social systems and cultural systems. And then went and became a financial journalist writing about Wall Street. So not entirely obvious.
So
literally from the tribalism of the Afghan mountains to the tribalism of your average investment bank. That's my background.
No, but why are her insights so valuable is because, come to our world, when you take us out of our comfort zone, we're humans. We do one of two things. Either we resist it like crazy, or we say it is temporary and reversible. And so far, this has been the right thing. If, however, you expose us and take us really out of our comfort zone, you paralyze us. That's what happens. You paralyze us. Okay? And embracing that we're out of our comfort zone is really, now, if you've grown up in emerging markets like I have, okay, you were wired to do that because you got taken out of your comfort zone all the time. If you've been mostly in more mature markets, okay, it's a new reaction, and we haven't developed the muscle. So I'm saying embrace it, and you're going to find there's a ton of opportunities out there.
Well, that's a very powerful point to make. My last question, though, really leading out of this, is that you, like I, spend a lot of time in the White House, at the Fed.
I don't spend time in the White House, by the way. I just don't.
Okay. Well, you don't spend it.
You do. I don't. Okay. I let it go it go the first time, but no. Okay.
Okay. Well, you spend a lot of time around the White House, let us say, and you know quite a lot about what's happening there. If you were a betting man, do you think that in a year's time, Chairman Powell will still be in his job? And how serious is the threat to Fed independence today?
Yes and hi. I think he will be in his job because he knows that any other outcome will be viewed as political interference. Right? And I think that he's someone who understands the importance of the reality and perception of central bank political autonomy. So yes, I think he's going to be in his job, even though I think the attacks are going to start again for the reason you cited earlier. But there is all around the world an attack on central bank independence. Right? And it's something that can be changed. It's not God-given. It can be changed. And it's already being changed in Turkey. I mean, I can cite in Argentina, I can cite example after example where it has already happened. And it's going to be at risk in the US and in Europe.
Well, thank you. Well, as I said, we really could talk all day. Unfortunately, we are out of time. Your last book was called The Only Game in Town. I think maybe your next one should be called either Heaven Help Us Find a New Game in Town, or How I Learned to Stop Worrying and Learn to Love to Be Bimodal. So, not very snappy, but I think it captures the point. But thank you very much indeed, and best of luck to all of you figuring it out.
The 2019 Greenwich Economic Forum is brought to you by Bridgewater Associates. Meaningful work, meaningful relationships. Churchill Asset Management, Nuveen, a leading provider of senior and unitranche debt to middle market companies. Ropes & Gray, bright past, brilliant future. Aurora Capital, inspiring partnerships. And Gramercy Funds Management, we are emerging markets. Special considerations to Bank of America, life's better when we're connected. Noah Private Wealth Management, a leading wealth and asset management service provider in China. Guotai Jinan Futures, a leading brokerage firm for commodity futures and financial futures in China. China Industrial Securities, a comprehensive financial group providing full spectrum financial services in Hong Kong. And Titan Advisors, built like a hedge fund. Special thanks to the Financial Times and Greenwich Business Institute for hosting us. And thank you to all the sponsors who helped make this event possible. We'll be right back after these messages. Don't go away.